Welcome back, everybody. Well, the last 2 weeks have been just pretty uneventful in the markets. I mean, there's nothing to see here, right? Totally normal stuff. Okay, well, maybe not quite. Now, I don't know about you, but I personally have seen my portfolio go from all-time highs around $385,000 down to around $330,000 in the span of less than a month. I mean, ouch. So clearly we should probably be panicking, right? Well, no, but I have been pretty active in March. So in this video, we're going to go over 2 positions that I trimmed, 3 positions that I added to, and my thought process for each one, plus how I'm approaching my portfolio as the market keeps going down. So let's go ahead and get started. Now, first off, I trimmed 2 positions in early March, and the first one that I trimmed was Apple. And believe it or not, I actually kind of told you that this might happen. Overall for Apple, it was a quarter that was pretty much like their last handful of quarters. It was pretty good, and it was what we expected. And for me personally, it's just a little under 10% of my total portfolio, and for now at least, I plan to hold. Now, if there ends up being a really great opportunity out there in the market that I really want to take advantage of, then my Apple position may be one where I consider trimming, but I have no plans of getting out of it completely, and at least for now, I'm just going to hold and see what happens. And ultimately, things did start coming down, so I decided to trim there. Now, on March 3rd, I sold 70 shares of Apple at a price of $240.83 a share, and I still have 86 shares of Apple left. And the bottom line for Apple is just that its value compared to its outlook just isn't as good as other things in my portfolio. Plus, I was disappointed to hear about the delayed Siri LLM, and there were other things that I thought just gave a better risk-reward combination. Now, overall, I still hold Apple in my portfolio, and if I look at how they measure up from a strategy perspective, Apple is still strong in 3 of the 4 categories. The question for them is obviously growth, which in this case is represented in cash flows. Now, I don't have any plans to actually sell Apple completely, but I do think it's likely that maybe they trade down a little bit until that growth comes back. Now, the second position that I trimmed in March was actually McDonald's, and I've always said that I love McDonald's. It's one of those companies that actually has sentimental value to me, but it didn't need to be 8% of my portfolio. So on March 3rd, I sold 50 shares of McDonald's at a price of $306.83 a share, and I still have 50 shares of McDonald's left. Now, I toyed with the idea of maybe doing covered calls for McDonald's to get a little bit more return out of a stock that I wanted to hold long term, but may struggle a bit to grow. And just looking at it, it's one of those things where it was going to add a bunch of complexity. It would make people have to worry about timing of when to sell the call and looking at price ranges and all that. And I just decided that if it was something that I was worried about doing and I didn't feel like dealing with it, then anybody who jumped into it because of me would probably feel the same way. So I just kind of gave up on it and said I'll just trim it to an allocation that I'm comfortable with and leave it at that. Now, in terms of McDonald's business, their growth outlook is a little worrisome right now, and their alignment with secular trends is weak and in some cases actually negative. So for me, it was a pretty easy decision to trim them a bit and make my holding a little bit more symbolic and a little bit less impactful to my overall portfolio. Plus, there was just better opportunities out there in the market. So speaking of those opportunities, what did I actually buy? Well, first off, I bought more a Taiwan Semiconductor. On March 3rd, I added 59 shares of TSM at $175.12 a share, which brought my total position to 200 shares. Now, I've talked about them a lot recently, so it shouldn't really come as a surprise, but from a strategic perspective, they obviously hit all the marks, and like I've said many times, they're pretty much irreplaceable in the current AI supply chain. And with news coming out seemingly every day about new and well-capitalized clients using their services and establishing a larger U.S. presence, to me, those are all positive signs. So when a company like that is trading for a 12 to 13 projected price to cash flow, it's just too hard for me to pass that up, regardless of what's going on with tariffs or macro. Now, I also decided to add to my Snowflake position. On March 4th, I added 55 shares of Snow at $168.36 a share, which brought my total position to 141 shares. We've already gone in detail of why I like Snowflake. Now, obviously, from a strategic perspective, they hit the marks in terms of secular trends, market advantages, and growth, but from an ROIC perspective, clearly they're not there yet. And I even mentioned recently that from a valuation perspective, Snowflake just isn't as attractive as pretty much everything else in my portfolio. But being that I just added it and the price came down to an even more attractive level than I initially bought in, I decided to go ahead and add to my position and take advantage. Plus, as Snowflake continues to get swept up in the enterprise AI trend, I think it's only going to help their growth going forward. And lastly, I decided to add a decent amount more to my Amazon position and actually bought it twice over the last week or so. The first one being on March 3rd, where I bought 24 shares at $203.53 a share. And then again on March 10th, I bought 44 shares at $191.47 a share, bringing my total Amazon position to 318 shares. Now, Amazon's been one of my largest holdings for a while, so this really shouldn't come as a surprise. From a strategy perspective, they fit extremely well, and to be honest, you could probably add more trends and advantages that I even missed on this slide. The one area where they're still improving, obviously, is ROIC, but it's also a little bit skewed with how much Amazon puts into R&D, which obviously lowers their ROIC number, but, still. And the reality is companies like Amazon are in the news just about every single day because of how vast and wide their business is. Whether it's cloud, robotics, AI, e-commerce, they're just everywhere. And Amazon's just a company that I just have the utmost confidence in that they're going to end up being a long-term winner in whatever market segment that we're talking about. It's just a company that as a consumer, I love their services, and as an investor, I just love their business. So for me, it was one of those things where I hadn't meaningfully added to Amazon in a while, and I felt like this recent drop was a good reason to go ahead and do so. But I have had some questions about NVIDIA. Now, I will say I was very close to buying NVIDIA instead of Amazon on March 10th, and I think NVIDIA was sitting somewhere around $105, $106 a share, but I just felt that Amazon was a slightly less risky long-term bet, just because, as you know, NVIDIA tends to have really wide swings on news and just happens to be in a space where news is happening pretty much every day. So I was close to buying NVIDIA, but decided on Amazon instead. Now, if we take a look at my updated portfolio weights, we can see that Amazon is now over 18% of my portfolio, Taiwan Semi is now over 10%, Snowflake is over 6%, and the companies that I trimmed, like Apple at 5.5% and McDonald's at around 4.5%, now make up a smaller part of my portfolio. So in terms of overall what I'm doing here, obviously, I'm not panicking as the market has gone down. If anything, I'm kind of doubling down on some ideas that I have. You could even say that I've trimmed out of what people probably consider, quote, safer stocks in Apple and McDonald's, and added more to companies like TSM and Snowflake, which carry some added volatility and risk. And look, the reason why I'm doing that is because I'm evaluating these companies over a reasonably long time frame. The fact that I'm using secular trends at all should kind of show that, right? So as much as people try to criticize me about, oh, you trade too much and all that, my viewpoint on these companies isn't just a year in advance or 2 years in advance. It's just one of those things where we don't know how long these trends are going to take to play out, which also kind of highlights a slightly different aspect of this to me. Because when the market started going down, I could have easily just looked at my watch list and seen whatever new stock I could have added to my portfolio. And I may still do that because there's nothing wrong with that, but I decided to focus on the companies that I already knew really well, the companies I already had in my portfolio, and just adding to those positions. Because I think sometimes we focus too much on what the new thing is and not just methodically buying companies we know well whenever they start to look attractive. I just feel like that's a more likely road to success for a lot of people instead of maybe buying like 30 companies that you kind of know because you feel like, hey, at least I'm more diversified. Because my approach in that case would just be, it's probably better just buy an ETF and not even worry about it at all. But that's just how I view it. I just don't think we need a ton of different stocks to make a material difference in our finances. We just need a handful, or in my case, 10 or 11, that we really understand well and continue adding to at strategic times. Now, if you missed my recent thoughts on Google, and if I think it's undervalued right now, you can check that out by watching this video right here. Hope you guys have a great day out there. Financial independence is true freedom, so keep building and stacking wins, and I'll see you on the next one. Peace.